It's that time of year again, time for estimated tax payments, so let me help you avoid a common mistake. Hi, I'm Phil, certified financial planner and founder of Flying Forward Wealth Management, and for today's video, let's talk about underpayment penalties. So what exactly is an underpayment penalty and how do we avoid it? An underpayment penalty comes when we have exceeded the threshold for when we actually owe the government money. So when we file that tax return for the year and then we see that we owe the government money, there is a certain threshold to where the government will actually penalize you or the IRS for owing them money. They don't like giving you a 0% loan. Currently for 2024, that penalty interest rate is 8%. However, in those situations where the IRS owes you money and they take longer than their administrative time, which I believe is around 45 days, then actually you may get the same 8% interest annualized for your repayment. So what's the threshold? How do we avoid the underpayment penalty? We want to ensure that we are on track to pay at least our safe harbor amount. And now there's a couple ways that we calculate that amount. The easiest safe harbor calculation is to look at last year's tax liability. For those married filing joint, if you look at your adjusted gross income for last year and it is less than $150,000, your safe harbor amount is 100% of the taxes you paid last year. So as long as you pay last year's tax amount, 100% of that amount this year, even if you owe the government money when you file your tax return next year, there will not be a penalty associated with it. Now, if you are above that 150,000 AGI threshold, then that percentage jumps up to 110%. So as long as you pay 110% of last year's taxes, even if you are underpaying for this year, and you've met that threshold, there will be no extra penalty associated with it. However, the more accurate method, but it is a little more complicated, is to actually calculate what taxes you're expected to be paying for this year. Now, if you're working with a tax professional or a tax planner of some sort that can actually help you do this, this is the method I would recommend. So as long as you are on track to pay 90% of this year's tax liability, again, there will be no extra penalty associated if you are underpaying slightly for the year. So to recap, there's two methods for us to calculate our safe harbor amount. We can either look at last year's taxes. If we have an AGI for married couples, $150,000 or lower, as long as we pay last year's tax liabilities, we're okay. We're not going to have an underpayment penalty. We still owe the taxes that are due if they're due. If you're above that threshold, you want to make sure you're paying at least 110% of last year's tax liabilities to avoid that penalty. Or the more accurate method is that we pay at least 90% of this year's tax liabilities to avoid that underpayment penalty. If you're ever wondering if you're on track or what's your safe harbor amount, I'm always here to help. Feel free to reach out. I'm more than happy to explain how we take care of this for our clients at Flying Forward. But until next time, remember, when you navigate your wealth, you elevate your life, and I'll see you next time.